welcome. I am Sarah Snell Cook, your host for the Credit Union Connection. And I'm here today with two wonderful gentlemen. We got Joe Gracia he's the founder CEO of Nichols,
Hi,
which
Sarah.
is good to see you again, Joe, which is he describes it as the NerdWallet for credit unions. And Tyler Kuhn, again, welcome. Tyler is from Service Credit Union. He is the VP of Marketing Digital Strategy.
Yeah, thanks for having me.
Absolutely. So I'm going to let you guys do a little bit deeper dive on your introductions. Joe, why don't you start?
Sure. So I am the CEO of Nichols. We are a credit union service organization. We only work with credit unions. We were founded in 2019, and we have a few different products helping credit unions in the area of credit cards and credit card debt. And our most recent product is one we launched end of last summer, which is called CardFit. And so it's CardFit that is the NerdWallet for credit union credit cards.
Mm-hmm. And you, Tyler?
Yeah, so I am the VP of Marketing and Digital Strategy here at Service, which I oversee digital strategy, data, and most importantly today, marketing.
Of course, most importantly, marketing. I wish everybody had that attitude. All righty. So, Joe, I'm going to go ahead and kick it off with you. Credit unions historically haven't been that into credit cards, whether it's, it's too much competition from the big guys or what have you. What do you think? What made you think that it was the right time for CardFit?
Sure. Well, if credit unions aren't into credit cards, why launch a company that's trying to help them with that? In my experience, you're exactly right. Credit unions aren't super big into credit cards. Maybe that's like priority number 7 on their overall list, but they are big into member growth. And that's typically priority number 1, maybe priority number 2. And the opportunity that we've seen is that credit unions historically haven't been using their credit cards to acquire new members. They cross-sell their credit cards as they bring them in on an auto loan or a mortgage, but they're not using credit cards to acquire new members. And that's where we see the big opportunity where someone can get a credit card without having to directly displace a current mortgage or a current auto loan or something like that, kind of part one. And then part two, we really, and this will be a little bit of a longer answer, so you can cut this down if you want, but we actually got into this a couple years ago when the CFPB approached us to join a tech sprint where they were trying to increase credit card competition. And we saw through the data that half the country, it's now about 60% of the country sometimes carries a balance on their credit cards. And for them, they earn about $42 in rewards, but get charged over $456 in interest and fees. And so they're on the wrong cards. Credit unions, by and large, are capped at 18%. They win on rate. And we've seen that credit unions really struggle to market around rate when everyone's talking about rewards and cash back. And that's where we saw the opportunity. Sorry, I got a little excited and long-winded there.
Absolutely. I like people who talk a lot because it just makes the video much more in depth. So, and Tyler, I'm going to go with you now. What is Service Credit Union's history with credit cards?
Yeah, so I think it's been, prior to maybe 5 years ago, it was similar of, we had the product, but it wasn't something we positioned as a member, acquisition tool. We weren't leading with it, like most credit unions leading with, auto loans and checking accounts and CDs. We've grown that portfolio quite a bit over the past few years. We continue to see growth in that portfolio. We've definitely, think it's an important product for us and for our members. A lot of people struggle with, especially in today's economy, they struggle with credit cards. They struggle with spending. And points are great. We kind of have a points card. We also have a low interest rate card, and we believe that, both of those are value to our members. And so, it's also a profitable product. We look at our portfolio of products. Credit cards are one of the more profitable products in our portfolio, right? And so I think for us, it's extremely important. The interchange makes a lot of sense for us, and something that we definitely we love to have. I think driving non-interest income as we approach the 10 billion mark and start planning ahead of what that's to look like. Credit cards are extremely important to us, and so I think for us, it's important to us to grow with those cards as an institution. We also believe that we can do, like you heard Joe say, we can do better for our members than they're getting from other places, right? So yeah, you can get the $50 in cash back, or you can get the 10,000 points, that's $100, but we can save you that if you're really going to carry a balance. And over half of Americans do. And so we believe that we can be competitive, but we can also add value to those members.
Yeah, and I think there's a lot of education there about around the rewards and what you're really paying for them. And so, Tyler, I'm going to ask you also, why did you decide to go with CartFit?
Yeah, so it started off as just a test, right? A POC to, hey, does it make sense? I think there's a lot of people that want to get in with the nerd wallets and want to get into some of the affiliate marketing. You know, we do some of that. But Card Fit was it's a, kind of a low barrier entry into that world. And I think for us, it's an opportunity for somebody to test out and to see if they can get approved without actually putting an application in. And so for us, I think, I'm sure we'll dig into the data, but we're seeing, some funding efficiencies and some approval percentages going up with the apps we have, but it's also a good way for people to compare us and stack us up to others. But also, I think CardFit does a good job of saying, hey, listen, you might want a rewards card, but have you ever thought about this, right? So it gets
Mhm.
to the heart of who is the borrower, what are you looking to do you carry a balance, and it makes a recommendation. And I think those sites, like NerdWallet, they carry a lot of weight and people listen to them. So for us,
Mhm.
it was a neat opportunity, not something we had seen before, and we definitely wanted to test it out.
Yeah, yeah. And so, Joe, that's perfect segue into what I was going to ask you.
Thanks, Tyler.
Um, at, we've talked about NerdWallet a lot because this is going to be the NerdWallet for credit unions. And so the reason a lot of credit unions aren't in NerdWallet itself is because of the field of membership restrictions. And so how do you solve for that?
Sure. Uh, it's funny. I think most people think that NerdWallet has like every credit card in America in the system. When you actually start to dig in, there really aren't that many cards because they're basically just working. And if you look at their credit card partners, which they are clear about, they're just working basically with the big banks because they want to be able to just work with a smaller number of institutions that can drive a lot of business. And so we've done a couple things differently. One, our comparisons are around total card value, which factors in both rewards and costs because those big comparison sites that are basically working with the big banks are oriented around intro offers and rewards where those big bank cards win. But for more than half the country, when you start factoring in total card value, credit unions just have a better credit card product for those users. And so, what we quickly realized to that field of membership question was we had to create a card comparison website that actually operates through the patchwork of all these credit unions in different communities with different fields of membership. So what we do is when you come to cardfit.us, the first thing we're doing is either pulling your location through your phone or your computer browser, or just asking you where you are, so that we can then take that location and identify what local credit union partners you can be qualified for that will then show you card comparisons on. So if you're in Southern California, yeah, you're not going to see a Service Credit Union card, but we can handle all the different field of memberships, and we're willing to do that because that's part of working with credit unions to be able to route people wherever they are in the US to include local credit union options.
Yeah, and that's a problem for credit unions in a lot of different areas of the business as far as like the business partners or vendors, if you will, wanting to only work with the big guys. And so 90% of the credit union population is not in the running. Um, and I think QSO's, definitely a great way for credit unions to get what they want without having to deal with people who don't want to deal with them, basically. So Tyler, what were your objectives? What were you trying to solve when you that led you to Nichols and CardFit?
Yeah, I think just driving more leads, right? Like
Mm-hmm.
finding, a few different feeders to get leads. I think, but in that, finding higher quality leads, right? Like what every marketer wants to do is find higher quality leads. I think there's not a credit union in the country, and if there is, I mean, I'm all ears to listen to what they're doing, but there's not a credit union in the country that's converting on a lot of the leads they're getting. There's a lot of places to drop in the pipeline, whether that be, before the application, during the application, but the worst place for them to drop is after you've gotten the application, right? And not to get that lead to go through. And so I think for us, it was really how do we get good leads into the pipeline, maybe even discourage people who might not apply might not get it to not apply, right? Because we get a better sense of what our spend is going after. And so for
Mm-hmm.
us, I think, we set out to get higher quality leads and to get leads that had a better chance of funding. And I think from, what we've seen, the last time I checked, the approval rate was, or the funding rate was about 25% higher leads that come in through, a normal channel or a non-Nichols or a non-Nichols lead. So for us,
Mhm.
it's accomplishing exactly what we wanted, and it was that high quality lead.
And do you happen to know the dollars and cents of that?
So I think for us that there's a lot of there's we know a lot of the dollars and cents of the profitability. It's a newer partnership, so to see what like if these card holders are performing differently, I think we'd have to kind of let that bake out. But I think the most important first step is getting a card in their hand, and we're seeing that they're doing that at
Yeah.
again about 25%, 25% higher than normal leads.
Yeah, yeah, and to Joe's point, getting more members. Um, so Joe,
Tyler, you can choose to have us edit this out, but to just provide like a sense of the pilot with service, we've spent like tens of thousands of dollars, like more than $10,000 in paid digital at this point. I think we've driven, over 1,000 credit pulls successfully for users that are in the area of Massachusetts and New Hampshire that are interested in a service card, and we've sent, well over 100 leads that are meeting services criteria to be able to possibly or likely get approved to get in to kind of just give a sense of numbers. But Tyler, we
mhm,
can edit that out if you want.
Yeah, for sure. I mean, I think for us, like the numbers that we're seeing is general leads. Or everybody wants to compete in the digital space. General leads that we're seeing convert at about, they get approved at about 31%,
mhm,
31% clip, right? So the 31% of applications that come in get an approval. With Nichols, we're seeing 47%, right? So we're
mhm,
talking like drastically different. And so again, I don't know marketers that are seeing 1 and 2 approvals on leads that they're driving, but that's what we're seeing, right? And so for us, there's tons of value in that, and there's tons of value in knowing that hey, we can put our dollars towards something where like not only can we get somebody to apply, but we can get somebody who's actually going to get approved to apply.
mhm.
Because I think, I don't think I'm alone when I can say it's really, really easy to drive applications. That's super easy. Anybody can do it. If you have money, you can do it. Driving good applications is where the rubber meets the road. And I think
Right.
that's, again, like you heard the stats, that's what we're seeing.
Yeah, that's a really amazing bump. The and Joe, can you speak to overall results for credit unions in general?
Yeah, being super transparent, I will say like service, and there's a reason Tyler's here. Like they're one of our best partners, and so it's really been a good working relationship, and them kind of meeting us halfway, and also doing things on their end when they're seeing like, hey, there's other things that we can do to make this all be more successful. Overall, right now we're spending like more than 8,000 a week in paid digital ads. We're driving over like 700 successful credit pulls across users a week, and we're typically generating about like 50 to 70 qualified leads. And what I say by that is we have a check eligibility process with first name, last name, and phone number. The user can initiate a soft credit pull. And then we can use that and match it up against the criteria that the credit unions have given us to be
Mhm,
able to tell the user in real time, are you likely to get approved for this card? Are you a possible approval? Or if you're unlikely. And if you're unlikely, we can try to cross sell other credit union products at that point. Like, but you might be a better fit. We see you have an auto loan, refinance that, but we're not going to send them down a path with an apply now button to go apply for a card if we can see that they're very unlikely to get approved. And so
mhm,
that's the filtering that we're able to do on our end to try to make sure that we're only bringing qualified leads over to the credit unions. And that's the stats. Once we pass, we're lead gens. So once we pass them over, it's in the credit union's hands. But
mhm,
that's the stats that I can share in terms of like what we're doing in paid digital spend, how many credit pulls we're successfully generating, and then how many of those people are passing likely or possible approval on those unsecured cards.
mhm. Yeah, and right now, and both of you can speak to this, delinquencies are on the rise. And credit scores have plummeted, especially since the student loans have started getting reported again. So, what's your take on all that as it pertains to credit union credit cards?
I'll take first stab at it.
Okay, you go
Yeah.
first, Joe.
I would say two things. Like I think it's pretty well documented that in a recession, unsecured debt is like the first thing to take a hit. And like that's just a fact. And so we are seeing that credit unions are have tightened up over the past months about like what they're going to approve for a non-new member in unsecured debt. That goes back to like your original question to me. And the point though is that we see CardFit as a great mousetrap to hook people and bring them in and let them know about credit card products that's leading with a credit card. But then once we have that credit report and that pull, we can identify other cross sells throughout the way that can still make sense for a credit union to bring someone in. So it's not that CardFit is only about getting as many credit cards out there as possible. It's about using credit unions cards to drive new engagement and potential membership than they've been doing previously. And that's something I'd like to believe can still work even as we go through these market cycles.
Yeah, there's often a flight to safety for credit unions or toward credit unions.
Exactly. And I pay attention to this stuff, but I've even seen a lot of the big banks really start to hammer like 0% for 18 months and things like that, because anecdotally, we're seeing a lot more rate sensitivity and interest in what the APR on cards is, which is an opportunity for credit unions that have lower rates.
Yep. All that great information out there from NerdWallet and CardFit. Tyler, what's your response to that?
Yeah, I mean, I think there's a lot that can happen over the next, 24 months even. I think, you see the rise of buy now, pay later. You see the rise of all these different types of payments, and I think it's something we've got to keep our eyes on. I think credit cards, they've been under attack, both, from a regulatory perspective, but also, I think from big banks attacking what we're able to offer. I think when you look at credit cards, I see more of like the next 24 months there being like a adoption surge with like digital wallet integrations and contactless payments. I think credit unions that can meet those needs have a great opportunity. I think, you definitely see unsecured debt rise. But again, by 2027, I think is they think over half of all payments are going to be made in a digital wallet, right? And so I think if you can have your card there, position it in a unique way, I think it's a big win. I think there's definitely risk involved with charge-offs and everything that's happening. But I think there's a lot of alternative scoring methods. Like, we have a few AI models, and so things that we can get ahead of some of that and, kind of like find where we're able to take risk. So
Mhm.
I think it's not going to be, I think from a risk perspective, it won't be unprecedented. Unprecedented. I think
Yeah.
it's going to be similar to what we've seen before, but I think it's going to be again getting the right card in the right person's hands and then getting them to utilize it, right? And so I think for us, there's definitely going to be risk, but the profitability on the products, they can be higher, right? And so I think it can offset some of the risk that you have. So I think credit unions will pick their spots, and some will strategically choose to adopt credit cards. Some may stay away from them, but yeah, I think where we are right now is, we definitely think it's an opportunity and we want to lean into it.
Yeah, absolutely. And so I always allow my guests the final thoughts of these interviews. Joseph, we started with you, I believe. So you go first with your final thought.
Yeah, I don't know, final thought, but summary would be like we're learning a lot. We've iterated a lot. We've layered in like not only credit score eligibility check, but now pre-qual report. We're now going to be working soon with multiple bureaus and doing that. And so it's been really great working with credit unions like Service and through Filene and their pilot like that to really figure out how we can tune and iterate to get CardFit working for them. And so a little bit of a unabashed sales pitch, like as Tyler mentioned, we've tried to make it incredibly easy for credit unions to trial and pilot CardFit, where all they have to do is fill out a launch worksheet, letting us know where they want to go grow, what their credit criteria is, and then what the paid digital budget would be. Because we do want to make it easy to work with credit unions to try to figure out a solution that's going to be right for them long term. So that's my unashamed plug rather than thought.
And Tyler, how about you close us up? What do you have to say to your peers?
Yeah, I mean, I think just from a marketing perspective, I've never met a marketer that didn't want better quality leads in their funnel. And so I think, with that, and then, again, this all started with a POC for us, and like just being willing to try something and try something new with a spend that probably already exists. I don't know why you wouldn't, right? You can do something with a digital spend that already exists and get better quality leads, right? And if you don't, then I think it's a small risk with, a greater reward. So I mean, I don't know why you wouldn't try it, but it's been great for us so far.
Awesome. Well, thank you so much, gentlemen. I appreciate your time this afternoon.
Thank you,
Thank you.
Sarah. Thanks, Tyler.
See ya.